How can you know what the price of healthcare will be in the future? Meaning, how much will you pay for healthcare in the future? Suppose that the average person today, based on aggregate healthcare expenditure, is paying $10,000 a year. What is that going to be in 2 years, 5 years, 10 years down the line? And what has historical prices and healthcare premiums told us about what the price is today? Well, this is what I am doing in this continuing analysis based on healthcare expenditures. And one of the first things we're going to look at is what's the healthcare CPI stated by what we are pulling in from government statistics from the St. Louis Federal Reserve. And then how does that compare to the actual expenditures that have been used, or the actual dollar expenditures within the United States for the past 20 years, and then compare to gold. I'm going to explain why this is the case and why we're using these three things. The three things, again, are your healthcare CPI, the price of gold, and then actual expenditures, which is from CMS.gov. With all that being said, let's get into this data. One of the things that I wanted to know was, okay, what's the price of healthcare, or what is the expense of healthcare been in the past? And what are we trending to in the future? And so, one of the quick ways that I was able to do this was to bring in Fed data, or St. Louis Fed data, that had the consumer price index for healthcare services and overall healthcare within the average city. And so that is what I'm pulling in this chart here, which has healthcare CPI starting all the way back from 1948. What they state is that 100, the CPI of 100 is in 1983, 1982. Why does this matter? Well, because the price of gold intersects with the healthcare CPI at this 1982, 1983 mark. And as you can see, since let's say 71 and earlier, the price of gold in terms of dollars and healthcare CPI has gone through the roof. And this is a good way to kind of get a big high level understanding of what's going on with prices in healthcare and why they will continue to go up at an increasing rate. And so all this to say is that I'm trying to prove out here, hey, is gold a good placeholder for hard assets, or what the real price of healthcare should be? And we're comparing it against healthcare CPI. And the reason why is because these are the government statistics that they are saying is the consumer price index for healthcare and healthcare related services and everything within the healthcare industry. And so this chart kind of says that story, meaning that gold for the longest time was pretty much flat, and then in the 2000s, for a series of reasons, it went up and is now at the point to where it's catching up to to the CPI. And really, it's dependent on the time frame you use. So if we use, let's say, 2000, the year 2000 to today, to 2024, it's trending pretty closely. Gold is much more volatile than the government stated CPI number, but both of them trend more or less in the right direction, and they both cross in interesting places. And so directionally, and more precisely, in specific points of time, they converge so that they're somewhat reliable metrics to use in terms of what is the price of healthcare and what are the expenditures of healthcare going to be in the future. Another thing that I wanted to know, which may seem interesting or may seem not according to conventional thought, is expenditures per capita to gold price. And what I'm trying to do here is something a little bit different as well. What I'm trying to say is, for every single ounce of gold, how much would you have paid in ounces of gold for what you are paying in healthcare? In other words, what's your ounces of gold per expenses in healthcare? And so, to give you just to give you an example of what it means here, is that in 2002, you would have had to pay 18 and a half ounces of gold for 1 year's worth of healthcare. Today, you have to pay 7 ounces of gold for today's healthcare. And the reason why is because if you look at 2000, the price of gold was $279. Today, the price of gold is $2,600. And so you can see that today you need less ounces of gold, you need 7 compared to back then when you needed 18. There's a lot of ways that you can think about this, but I wanted to kind of know, hey, is it better to price things in gold and hold hard assets in gold versus dollars? And I would say this is kind of trending out because what you could have done is said, well, the price of gold is pretty cheap here. So I'm going to buy, let's say, all of my allocation of gold in healthcare, so that I can hold it for, I don't know, 20 years. And then when I need it, then I can spend that money. This is what I'm doing with gold is I'm essentially making that a placeholder for really any hard asset or really any long-term investment. And so if you have baby boomers that have held on to an investment, let's say 20, 30, 40 years, be it real estate, stocks, or whatever, then what you will see is that their asset price has gone through the roof. Maybe the asset hasn't correlated strongly with gold, but it certainly hasn't been that far off of gold in the long term. What I'm trying to say is that here, if you have, let's say, a population of baby boomers who have had to been able to accumulate assets over time, then they can be sitting in a place to where, relatively speaking, they're not paying that much for healthcare, even though the nominal dollar price is very, very high. That is opposed to, let's say, millennials and let's say Gen Z, where they are now entering the market and asset prices are already very elevated and they can't buy assets at the prices they used to be in order to then have this kind of exchange over time. But what you will see is that those who have assets, this trend will continue overall. And so if you even buy, let's say, gold at $2,600, in the future, that $2,600 for gold will be, let's say, $3,000, $4,000 for the price of gold because of inflation over time and because of healthcare CPI continuing at this pace that it has been continuing. Okay, with all that being said, now I want to know the percentage change, meaning on an annual basis, how much does gold change and how much does a CPI change over time? And so in this chart here, what you will see is that this gray line here is the price of gold. And so as you can see, gold is quite a volatile asset. There are a series of assets that are volatile, but gold is certainly up there. And so what I did was I smoothed it out and I took a 15-year average of gold, that's a trailing average. The reason I did that is because I wanted something smooth that you can compare instead of something that's abrupt. In other words, if you're holding gold or holding an asset, then you have to have a certain duration that you're holding it in. And so in this case, you're going to be holding it, let's say gold, you're holding it for 10, 15 years, and then you're going to sell it in order to, let's say, pay for healthcare or pay for something else. And so in this case, that's why I smoothed out the lines so that you don't get these sharp increases and decreases where the gray line would be these sharp ups and downs that you feel in the gold price. But if you're saying, hey, in 2001, I'm going to buy 5 ounces and I'm going to keep it till I'm, 75 or whatever, then that's a different mindset. Or if you say, hey, I'm going to buy this Google stock that is worth $100 in 2005, and then today that price has certainly increased. The same with Amazon or whatever else. What you can see is that there's a stark difference since 2001, between the CPI change and gold, meaning that the CPI is changing at a lot lower rate, than gold. Although you will notice even here, even today in 2024, CPI is 2.85% to where the gold price is increasing at at a rate of 17% with that trailing average. In 2002, you had CPI of nearly 10% for healthcare, and then you had a rolling average of 22. So you have twice as much, you have an inflation rate, at least over here, of twice as much of a price increase for gold as it is for the CPI in healthcare. The reason why these matter is because I'm using this as a baseline for digging deeper into the real price of healthcare and where healthcare is going in the future. Now we're going to get to healthcare inflation by age group. And so what I wanted to know here is, okay, what is the comparison between my expenditures on a annual basis, and how much on an annual basis do my dollar expenditures on a per capita basis change? And then what is that compared to CPI? Meaning, what are you paying on an annual basis? And then does that change over years? And how does that compare to CPI that's stated? And in most cases, CPI overstates the actual expenditures in healthcare, which is something that I didn't think would be the case. A lot of times, many people complain about CPI being lower than expected, meaning like rents and equivalent rents. So a lot of times they'll say the CPI is understated, meaning that the CPI states that the average person spends, I don't know, $800 or let's say $1,200 a month on rent or housing when the real cost is $3,000. Well, in healthcare, it's the opposite. In healthcare, the CPI is overstating what's actually being expended on a year by year basis and change, meaning that for some reason, Fred and the St. Louis Fed, they're actually over allocating the CPI for healthcare versus what's actually being spent in the economy. Now, this is for almost all cases. If you look at every age group here, there's some age groups where the CPI converges closer to what the expenditure percentage changes. But you'll see that for ages 0 to 18, it's very much overstated, meaning that the government statistics are overstating how much those who are 0 to 18 are spending and or the rate of change that they are spending in healthcare. Healthcare percentage change for 19 to 44 diverged, but then it converged more in 2014, and they're pretty much in line, although they can diverge. The working age population of 45 to 64, on the other hand, is pretty in line. Like I know that there are some differences here. Like for example, in 2008, the CPI change is let's say 8%, while the expenditures change is 7%. And so on an expenditure basis, the expenditures increased 7%, while CPI stated that the increase was 8%. On a per capita basis, though, meaning when you take into account the population, then it's 5%. But overall, you can see the chart is more or less in line. The same is for ages 65 to 84, which I argue today that's the most important age group when it comes to healthcare expenditures, because that's your baby boomers and those who are entering retirement age, which will be your dominant um, population within healthcare for the next 10, 15, 20 years. One of the things I did find very, very interesting, though, is that overall your healthcare percentage change is decreasing, meaning that your inflation rate for healthcare is going down over time, meaning that in 2004, let's say that stated CPI from government statistics was 8%. Um, Actually, on a per capita basis, it was 7%. Um, and um, and in between there, you had total expenditures. But really, you're talking 7 to 8% there. In 2018, it was down to 3 to 4% and came up in during COVID, and then now is back down to that trend. But you can see that the trend of inflation for healthcare is going down. And I wonder, okay, why is that the case? Why is inflation or the rate of change for how much you're spending on healthcare going down? And I've come up with two potential reasons why this is the case. The first is that healthcare is at the point to where it's so expensive to where people are deciding alternate ways of how to allocate resources to healthcare, meaning that they're siphoning money away from healthcare and using it in other ways. And so you can see this percentage change decrease over time. The second thing is that maybe what's happening on a per capita basis is that maybe that the change downwards is so much that there's actually a cap on how much healthcare spending that can be done in this economy. Meaning there is a threshold by which people and the government and everybody wants to spend in healthcare, and we're approaching that threshold. And the reason why I say we're approaching that threshold is because the percentage change is going down, meaning that people necessarily don't have an appetite to spend more on healthcare at an institutional level, but maybe it goes all the way down to the individual level. So this is government statistics for healthcare change versus your per capita expenditures and your total aggregate expenditures change over year. And so keep in mind that these are based on dollars. These are dollar denominated metrics in the sense that CPI is based on US dollars and expenditures are based on US dollars. Now, what I'm going to do is I'm going to introduce gold into the mix. And so what you will see here is that in 2004 to 2006, there was a drastic change by which gold, the price of gold increased and continued to do so at a faster rate than healthcare expenditures and the stated CPI. What this is saying is that the asset prices, and especially the prices of gold, crossed this point in the early 2000s by where it is more advantageous to put money into hard assets than it is to spend it in healthcare. So that in so that if you are, let's say, saving in a hard asset and then spending the money and converting it into money that you can use for healthcare, then you will be better off. And so let's say you bought, like my earlier example, let's say you bought in 2004, you bought a whole bunch of gold, you held it 2020, and then you sold it to pay for healthcare. Well, you have a gap there of about 23% where you're getting a discount of 23% on that gold. Another way to look at it is to say, well, you could have bought a hard asset in the early 2000s and then held on to it and then sold it to pay for healthcare. Another way to look at it is this is the actual real price of healthcare and the real price of goods and services in the market. The real actual price of these things are 20% higher than it's stated. And so if there weren't dollars and we only relied on hard assets like gold to exchange, or you could say Bitcoin or something else that's less fungible, then the prices of healthcare would be a lot higher than they are now. And they're actually being brought down and being, let's say, subsidized by the government to come lower than actually corresponding with the real rate of price increases for hard assets. And so you'll see this across the board to where it's really stark to see how gold essentially crosses this line in 2006 and then doesn't look back. And it skews the numbers and it skews the trends upward to where gold will skew the CPI and skew the price of everything upward um, because it's such a drastic increase. Now, I'm going to come back to this in a future analysis and explain why this is important, because what happens if the United States government goes through a default or a hyperinflation or a series of number economic hardship events that puts a shock on healthcare, what does that actually mean? And I'm going to go through that in the next analysis, and I'm going to bring to bear other learnings and other research that I have found from the Weimar Republic, from other countries that have experienced hyperinflation and economic shocks. Okay, so let's get to healthcare inflation by service. Again, what we're seeing is that on a CPI change, CPI is overstating how much you pay for services in healthcare versus the expenditures that that are being expended into the real economy. And it only really comes into, let's say, there are only specific places to where there's divergences, but overall it converges at least closer than not. it's still overstated. And the reason why I wonder if it's overstated is because they're using an overstatement in healthcare to then understate something somewhere else, and then doing so. But in this case, we're just looking at healthcare and don't really care about all the other things in the CPI basket, in economic terms. But as you can see, hospital care um, is essentially in line, where in 2004 you had 7 to 8% percentage change or inflation, and then back in 2020 you have 6 to 7%. And so it comes down to a dip, and then it comes back up, but the expenditure percentage change catches up with inflation, and inflation is kind of leading that indicator until the actual expenditures catch up with it. Again, here for physician and clinical, it's the same way, where you have leading CPI change and then it catches up in, let's say, 2014, 15, and 16, and kind of trends together. The interesting thing is prescription drugs kind of takes a huge divergence between 2006 and 2014. There's a huge gap there. And then CPI continues to lead with the assumption that expenditures for prescription drugs will then catch up to the CPI. But it's hard to know if that's actually going to be the case. The other and the fourth biggest spend as far as a service is other and health residents. And so as you can see, the trend in inflation is down, and it's pretty well correlated. If you want to see this in a table, then you can see the table below, where we're just essentially looking at services and comparing all three numbers. And then you can open up, let's say, hospital care, for example, and see all of these numbers all together correlated. One of the things I find very, very interesting is that the gold price on a year-to-year basis is very, very sharp. And so you will see the gold price increase 32%, increase like by 40%, and then drop by 24% 1 year, and then even out and then increase back again. So again, gold is volatile, and there are other assets that are volatile, but this is at least a stand-in for hard assets, that can then be exchanged for healthcare in the future, which is what many baby boomers and those in Gen X have been able to do to great success. What I will say is that the millennials and Gen Z can also do this to great success, but they have to be more patient because asset prices are already high. Lastly, I wanted to take another approach and kind of identify how you can understand gold and understand how it correlates with healthcare. And so what I decided to do was decided to say, okay, we have this percentage change or this gap between what is the stated CPI, or what is the stated rate of change for per capita expenditure. And then you have the difference or the gap between the gold price at the top, and then you have the gap between that and then what the expenditure changes at the bottom. And what is the difference between that and how does it grow? And so as you can see in this bottom chart here, as you can see in this bottom chart, the gold gap, which I'm calling it, is that difference between the per capita expenditures and the gold adjusted per capita expenditure. And so what I'm saying is that in real hard asset terms, this is the price that it would have been without the dollar. There's kind of two ways to look at this. I kind of explained this before, but the first way is that if the dollar goes away tomorrow, this is what you're going to have to pay a premium for in healthcare, because you're going to have to need hard assets in order to pay for many goods and services, especially expensive ones like healthcare. The second way you can look at it is that if you were to take and invest in hard assets in earlier times, like in the 2000s or the 90s or the 80s, then you can then cash it in, and that this difference and this gold gap is essentially the difference by which you will then pay. And so you will have invested, let's say, $12,000 and only have to spend $10,000 in healthcare. So there's two ways to look at this. There's the opportunistic way to look at it, and then there's the cost-based way to look at it. And so if you look at it this way, then you can see that the gold gap increases over time, of course, because you have that percentage change that that gives the advantage to those who are holding hard assets. The other way to look at it is gold adjusted per capita expenditures. And so you can then stack on top of your current expenditures this price that you will have to pay if the dollar isn't as good as it is today. Meaning that if you have further inflation, this is the hard asset price that you're going to have to pay for it. There are other ways that I wanted to break this down, and the first was by age group, meaning that there are certain age groups where they will benefit more than others. And so if you are, let's say, between the ages of 65 and 84, then you can benefit $15,000 if you invested early, and if you invested, let's say, in 2004, 5, 6, in that same amount of expenditures that you would have expended in healthcare, and then held that to when you need to spend it. Um, and so the age group of 0 to 18 doesn't necessarily benefit as much as those who are 65 to 84, but you can still see that that gold gap is certainly more advantageous to those who spend more money in healthcare. The same is by service. If you are using something that costs more, then your gold gap will be further increased. And so, for example, if we look at something like if we look at something like like hospital care, you're obviously going to get a better benefit if you invest early, because the price for hospital care and the service for it will cost more than other services, or the expenditures to hospitals are a lot more than other expenditures. The same as by payer. If you allocate an investment that is designed for private health insurance to pay for that, then you will be able to benefit from that and cash that back in. And so, in this way, I'm trying to help you understand that this gold gap can be used in two different ways. The first way is if you invest early, then you can then cash out, or you can then use that investment when you need to. And in real terms, you can benefit, and you can actually have a lower relative healthcare cost. The other way to look at it is if you miss out and don't invest, then you're going to have to pay this premium above and beyond if the inflation rate continues as it does. I hope this small little analysis helped you. Um, I hope this small little analysis helped you understand what we're trying to cover here as far as the CPI for healthcare, how it compares to expenditures over time, and then how you can kind of think about investing in terms of a hard asset when it comes to retirement and those ages when you're not working as much. So thanks. I hope you appreciated this specific analysis. Again, we're going to link the entire analysis in the dashboard in the link below that will give you the sources for all of this, so that if you have any questions, you can dig into the sources yourself. Or you can contact us on our website, and we'd be happy to answer any question you have. Thanks, and I will talk to you later.